Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Brian Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Brian are here to help you focus on what matters most in your life, living well.
Hello. Earlier today, I had a conversation with Apollo Lupescu, Vice President at Dimensional Fund Advisors, on the evolution of investing. This was a conversation aimed for advisors who listen to the Bucket Plan on-demand podcast with C2P. But we felt that there was so much valuable information for you that we decided to share the conversation here as well. We hope you enjoy as we discuss how investors understand the market, the benefits of a diversified portfolio, and the different types of risk as related to the Bucket Plan. Welcome, this is Jason Smith, and I have my guest, Apollo Lupescu. Did I say did I pronounce it right, Apollo?
You got it. It was
Awesome.
perfect.
I bet you have a lot of people struggle with that a little bit.
It is. And sometimes I think I'm better off with just like a one name, like Madonna and Prince, and just Apollo and leave it at that.
And you could pull that off with Apollo.
Might as well.
Welcome. We've had a long-standing relationship, and Apollo, he's the Vice President of Dimensional Fund Advisors, and really just has a little bit of a nickname, the Secretary of Explaining Stuff. He's got a unique ability of taking pretty complex things and simplifying it, which I think is great, and why I wanted to have you on here today. Apollo, actually, I'm going to be sharing this with both our clients of JL Smith, as well as the advisors that are with C2P, because I think it's so important to hear what you have to say, and again, how to simplify with what's going on with the election and why we should have our portfolios set up the way that we do, and just the basics of investing and kind of the evolution of investing. And I can tell you, Paulo, you may or may not know this. I think I may have told you this years ago, but my family has had the bulk of their assets with Dimensional Fund Advisors for several decades now. And I'm a huge believer in everything that you do. And I feel like we do at Dimensional Fund Advisors. And I've had great results by that commitment that I've had, and great peace of mind. So I appreciate you being on here today. And I'm a raving fan, but I'm also a client, and I'm also an advisor that talks to clients. So I can wear a lot of hats in this discussion.
Thank you so much for the invitation to be on this podcast, and for the trust and the partnership over the years. It means a lot, and I'm so glad to hear that you're not just suggesting this to clients, but it's something that your own money and your family's money has been invested the same way, because I think that alignment is huge.
Yeah, no doubt about it. And Apollo, let's just start with that. Let's just start with the basic principles of investing and Dimensional's belief in how they go about, I guess, the investment philosophy would be the best way to put it.
Yeah, no, it's something that is hugely important, because I think that what we share is this investment philosophy, this approach to investing. And to us, the first and probably one of the most important elements in investing is having a plan. In other words, it's not about what stocks you own, what mutual funds, what ETFs, what Bitcoin, whatever. It's more or less, what are you trying to accomplish with your money? And do you have a plan that was customized for your needs, your circumstances, your risk capacity, something that you can sleep at night? And then you can start putting pieces together. So the first thing, and I think that we share this, is the importance of an advisor to create this very customized financial plan, and make sure that when somebody has some objectives in the future, they're well understood. And whatever we do today, it is something that we're trying to maximize the odds that we will accomplish those financial goals, and those families will accomplish the financial goals. The second thing that we believe is that as an investor, it's not just about the plan, but also how do you go along the way to implement that plan? In other words, what's the process? How do you make sure that you pay attention to cost of investing, to taxes, to all these things that matter ultimately to the bottom line? How do you make adjustments along the way? Because things change, so you do need to make adjustments. And that process is hugely important, including rebalancing, something that means that when something really takes off and does really well, instead of letting it run, perhaps you want to trim some of these gains and then readjust the portfolio. And that's the second part. And the third part is that to make sure that you have an investment solution, investment product that really does the best job to help you both with the process and accomplishing that plan. So I think as an investment philosophy, what we do believe fundamentally is that number one, have a plan. Number two, have a process that guides that plan along the way to make any adjustments that you need, paying attention to tax is expensive. And number three, that you choose the right investment products, that you're not overpaying, and you make sure you get the best odds of success. And in that respect, there's also this idea of risk. And we do believe that as an investor, you have to pay attention to risk. But we do believe that there's some risks that are worth taking. They're smart risks, and other ones that are dumb risks. And Jason, give an example. If you're an NFL player and you choose to go on the field and play without a helmet, you're not going to pay that. You're not going to get paid anymore, but it's not the smartest thing to do. So it's the same in investing. You don't want to run on the field without a helmet. So you want to take the risks that are absolutely something that you get compensated for, but not the ones that you don't get paid for. And a really good example these days is Bitcoin. You hear a lot about Bitcoin as being this investment that might make you a lot of money. There's a tremendous amount of risk associated with it, which you don't get in stocks, because stocks are a very different animal. Stocks are about ownership in companies, and that ownership means that company has real people, real products, real profits. And in that respect, I can live with that idea that I'm buying a piece of a business, and that business might or might not make money every day. That's a risk. And I understand that. And if I spread my bets across enough businesses, I know that over time, I'm going to be better off than simply placing a bet into an investment like Bitcoin that, for example, doesn't have any fundamental economic value. It's much more based on sentiment rather than true economics. So I think that those are some of the beliefs that we have. The importance of an advisor of the plan, paying attention to the cost of investing, but also make sure that you spread your investments across a very large number of companies and you don't take unnecessary risks.
And when you were talking about Bitcoin, Apollo, and you say sentiment, now tell me more about that.
Yeah. So stocks, by the way, Jason, I always thought that the word stocks and stock market kind of resembles a bit of gambling. You make money, you lose money. It's not really well understood. Right. Fundamentally, investing in stocks means that you buy a piece of a company. You are part owner into a business. If you buy a share of Microsoft, you didn't start Microsoft likely, but yet you can be entitled to part of the earnings that Microsoft makes, pretty much like Bill Gates. Not as much as Bill Gates, but conceptually you have that piece of ownership. Right. And then you can assess how much should I pay for that ownership in the business based on what I expect the company to make in profits, knowing that a piece of those profits is going to come to me. So there's a way to value economically, even as you form an expectation without knowing for sure what the profits are going to be. You get a sense they have office, they have windows, and they're going to start making money over time. And that's what I mean by there's an economic value to, there's a productive capacity to that company. And we believe in that. That's a fundamental premise of our society. Bitcoin, on the other hand, doesn't really produce anything. It is not a currency because nobody uses it to buy milk or gas. No prices are quoted in Bitcoin. And also, it's not very stable. It fluctuates much more in value than the stock market. So you can't say that's a stable hold of value. So if you think about that, then what is Bitcoin? It's more or less like a baseball card or an Otani little bobblehead, which could graze in value because of sentiment. People believe that down the road, somebody else will pay more. But that's purely based on beliefs rather than any economic productive activity. And that to me is much more speculation rather than true fundamental investing where you can assess if something is worth and how much should you pay today to get a good deal perhaps for that particular investment or a fair deal for that investment.
Apollo, I appreciate that. And would you describe gold in the same way?
No, I think gold, I'm sorry, I got excited because gold is in a way similar to Bitcoin. That if you take a piece of gold, you put on this table, You come back in 5 years, it hasn't produced anything. It's just still the same gold sitting on the same table. Now, on the other hand, what makes gold a little bit different are two things. One is a bit of a legacy idea that up until 1971, when President Nixon decoupled gold from the dollar, there was this idea of a gold standard. That by having gold, I protect myself against any inflation or any loss in value because the gold was attached to the dollar. And up until 1971, that was probably true. Now, for the past 50 plus years, we have been a type of currency called fiat currency. That means that we are no longer tied to any precious metal, such as gold, but rather we believe that the government will be responsible with the way it prints money. So to us is the belief that the dollar has value, that it's given its true value. And that's called fiat currency. So I think that some folks might look at gold and say that was tied to the dollar and it's a protection against whatever might happen to the dollar. Not anymore. It's been about 50 years. Now, what makes also gold a little bit different is that you can have some industrial applications. You can make teeth, you can make jewelry, we have commercial applications. And in that respect, you can see that perhaps it's a little bit different than Bitcoin, which has none of that, but not by much. Not by much. It's still a lot of speculative aspects to gold. And I think that I think all of you folks on this listening to this podcast should have some exposure to gold, should have some exposure to crypto. But the way you ought to do it is through these companies that are part of the stock market. Coinbase, for example, it makes money from crypto trading and so forth. It's part of a diversified allocation. So why not have it? And also puts in perspective how big is the crypto world relative to breakfast and cars and gasoline and airplanes and so forth. So you ought to own it commensurate to its economic value. Look at gold. There are plenty of gold mining stocks, Newmont and so forth. There are all kinds of gold mining stocks around the world that you can participate and own a piece of those. And as gold goes up in value, so will your portfolio. Now, do I believe that somebody ought to have, outside of that, gold or Bitcoin? I personally don't think that you need it because you always have to go back to that question. What is the financial plan? What are you trying to accomplish? What's the best way to get there? And quite often, I don't see people needing to own gold or Bitcoin to get there. In fact, a lot of times they create more risk by including these investments outside of those stocks that have exposure to gold and Bitcoin.
And Apollo, if they did own gold or Bitcoin, what percentage as a total would you say those type of alternative investments that they would own that are more volatile, right, that we've discussed, of someone's total portfolio, what percentage?
Yeah, I think you have to look at what is the overall value of Bitcoin relative to the value of companies that you can buy. There are about 12,000 companies in about 40 different plus stock markets that you can buy. And when you add their value combined, it's in the trillions and tens of trillions of dollars. You have bonds, which are a different type of investment. You have real estate. You have all kinds of other investments that you can place. So relative to the size of the other investments, how much is gold and Bitcoin, and then use that as a starting point. So if the value of all Bitcoins in the world is about 1% of the value of these investments in which you can participate, then you should have about 1% in Bitcoin, for example, in your allocation. Similar to gold, which is probably much less than that. And then it begs the question, is the juice worth the squeeze? If you're going to put 1%, but it triggers all kinds of risks and taxes and blah, blah, is it really worth it? Because it's not going to really impact your life fundamentally by including that 1% or not including it in 1%. So I would say it's a very small piece commensurate to economic value of that particular investment compared to everything else that you can buy. So very small piece.
Excellent. Thank you, Apollo. And so basically what we're really talking about right now is risk, Apollo. And when we build our financial plans, we use the bucket plan, and it's a 3-bucket approach: now, soon, and later. The now bucket is basically our emergency fund, our planned expenses, our cash or cash equivalent, money that we want safe and liquid. The soon bucket is that money that we may need sooner rather than later. So we're going to take a different approach, a different strategy, and different set of choices on the money in the soon bucket because we may need it for income or withdrawals sooner rather than later. And then that leaves the rest of the money for the later bucket. The later bucket is primarily what we've been talking about today, the type of investments and in strategies and what we do out in that later bucket. There's a place for, we've talked a bit about stocks. We briefly referenced bonds. I loved how you explained stocks, Apollo. Explain bonds in general terms for people and the importance of having bonds as a part of that mix in that later bucket, even though it's a long-term time horizon and we know that stocks are going to do better than bonds. Why even have bonds out in that later bucket?
Absolutely. So stocks are about ownership. I think it's a fundamental premise of our society. It's an amazing feature because it allows all of us, even without having started a company, to participate in its ownership. So stocks are all about ownership. The value is derived from what do I expect that company to make in profits, and then I can assess how much to pay today for those future profits. Bonds are not about ownership, but they're rather about lending. Corporations and governments, including the US government, they need to borrow money. And instead of going to the bank, for example, the US government comes to us and says, Jason, if you're willing to lend me $1,000 today, we're going to write up a contract. And in that contract, we specify an interest rate that you will receive and for how long you get the interest rate. At the back end, when we specify the end of this contract, you will get back the $1,000 called the principal, and then we call it a day. We all walk away. You get your principal back. So the beauty of a bond is that there is a specified interest rate that you know that you will be getting for a duration of time. So if you deal with the US government, for example, you can go and have a contract for as short as 30 days. After 30 days, you get interest plus your principal back. You can go for 1 year, and after 1 year, you get the interest plus the principal. And what investors appreciate about bonds is there's a lot more clarity about what am I going to get if I own this investment. And some people, particularly as they are at a point in life where either they don't have a lot of other source of income, they don't have a paycheck anymore, and the Social Security is not quite enough, they want to know that their investments are more stable. They don't want the fluctuations that might come with the stock market. And because of that, bonds can provide a really solid alternative to the ownership in the market. So stocks are about ownership, bonds are about lending, and there's a really interesting dynamic there because mixing the two can really improve the outcomes over the long run. And Jason was talking about this idea of the stock market being risky. Let's look at the early 2000s. If you look at the early 2000s, you basically had 2000, 2001, 2002, 3 back-to-back negative years in the US stock market as we measure it by the S&P 500. 3 back-to-back, including a negative 22% in, I think it was in 2002. So very steep drops. And then you had the '08, such that by the end of the decade, if you had invested $1 at the beginning of 2000 in the US stock market, by the end of 2009, that dollar would have turned into about 90 cents 10 years later. And if you're a retiree and you depend on that portfolio, it's going to be hard to say, I'm going to wait 10 years plus to recover my losses. It's a very long time horizon.
Right.
So if you invest purely in the S&P 500, that can be a pretty long downturn that you might have to wait out before you recoup your losses. But here's the thing. If you put some money, not just in these large companies that are in the S&P 500, but you look at other companies, there are smaller companies in the US that are not part of the S&P. You look at some global companies that trade in other parts of the world, and maybe you include some bonds, your investment experience is going to be quite different, very different. And in fact, there's a book called The Matrix book and it's an investment book that's just a fantastic resource for advisors that looks at the dynamics of a more balanced portfolio and what is in a portfolio that's about 60% in stocks, some in the US, the S&P, international, emerging, smaller companies, and about 40% in bonds. Over that entire decade, instead of having a negative outcome, you would have had maybe about one negative year instead of this huge downturn that you have seen in the S&P 500. And even after 0809, by the third year, you would have been back in black. So it's a very different experience. And we've seen that stocks and bonds don't always move in lockstep. There are some years when they might, but generally speaking, in the data, we see that they don't. So it's a great benefit to balance the two while acknowledging what Jason said. Listen, folks, there's a very big difference in the growth of your money in stocks versus bonds. That stability comes at a price. And to give you a sense of the magnitude, if we have good data in the S&P 500 going back to 1926, and if you look at $1 invested in 1926 in the S&P 500, left alone through all the good times, bad times, that would have grown at a rate of about 10% per year average annualized, which means that $1 would have grown by the end of last year to about $14,000. $1 grows, and that was exactly my dad's lifetime. $1 grows to 14,000 in my dad's lifetime.
Wow.
Now, the alternative would have been to put the money into a safe investment. And let's say you dealt to the US government bonds, the 30-day, and you go to the safest one. 30 days later, you get your money back plus interest. These are called 30-day treasury bills. And over the same time frame, you would have earned about 3-4% per year on average annualized instead of 9-10%. And over the course of 90 plus years of data in the T-bills, there was never a negative calendar year. There was never a year when you open your statement and say, I lost money in these treasury bills. So much safer relative to stocks. And here's the thing. If you had invested the same dollar, which has grown at 14,000, if you do 9-10%, if you had invested the same dollar in the treasury bills, I'm encouraging you to put a number in your head. What do you think it is? Because with a little drum roll, instead of $14,000 in stocks, same dollar, same time period invested in T-bills would have grown to a whopping $23, not missing any zeros. So it's a very big difference between stocks and bonds. And this mix is the most important decision in investing. So I think that the way that Jason described is absolutely the right way to do it, which you look at the time horizon and you realize that stocks might take a little bit more to recover, but you need to put some bonds. And then the more you need some stability in your account, you don't want it to fluctuate wildly, the more you want to allocate perhaps towards these safer investments, which tend to be bonds.
And Apollo, basically, those treasury bills are equivalent to almost like a cash equivalent, where we put that, and that's what we use in the now bucket, something similar to that, where you want the stability, you want the safety, you want to know that you can call on it sooner rather than later now, right? It's why it's called the now bucket. You want to be able to know that you can call on those money for planned expenses, an emergency fund, whatever it might need, those immediate spending needs. That soon bucket is that money that's a little bit out, right? More in that 10-year time horizon, but not quite where the later bucket is, like we've been talking about. That's where we tend to lean more heavily towards bonds or other fixed income alternatives that we're going to earn a better rate of return than we will at the bank or in a treasury bill, but not take on the full risk like we would primarily in stocks out in the later bucket. We're looking to optimize return. We're looking to get the highest possible rate of return out in the later bucket because we bought ourselves the time horizon by having a plan. As you started with, having a plan, the now and the soon bucket give us that plan for our income or withdrawal needs or our life needs so we can have the confidence to invest the rest of the money out there in that later bucket.
And you're absolutely right. Not just the confidence, Jason, but also the peace of mind. I can sleep at night because the bucket for now, it is not subject to these wild fluctuations in the stock market. If the stock market goes up or down any one day, not really impacting me because my plan has a different investment for right now. So what happens in a day in the market, it's something that doesn't really impact your income and your needs right now, financial needs, because you have that bucket. So it's also about peace of mind, which I think is huge.
No doubt. And Apollo, let's go back to the later bucket for a moment. And Warren Buffett, basically somewhat of a theory of just invest in the S&P 500 and everything else is going to take care of itself. And you've already talked a little bit about the importance of also having, some other diversification, right, in that later
Right.
bucket. And I want you to
Right.
talk a little bit about global diversification as well, because the US stock market's done real well. A lot of Americans very patriotic. They say, why do I want global investments in my portfolio? Let's talk a little bit about that diversification and the importance of it.
Absolutely. So when professionals, when they look at investing, one of the first things they look at is how big, how relevant is a particular company. And what I mean by big, the size, that relates to how many shares of ownership does a company have. And you multiply that by the value of each share, the price per share. And when you multiply the two, you get a sense of the economic value, the what's called a capitalization. How much is that company worth it? What's the ownership value of that particular company? And when you run this exercise and then you look at different stock markets and the value of different markets that you can buy and sell around the world, in the same way that a company can be based in Alabama or in California or in Delaware, it's the same. Companies can be based all over the world and trade in different parts of the world. So when you run that exercise, you look at the value of all companies, the market capitalization of all companies that you can buy and sell around the world. What you find, interestingly enough, is that the US is the largest stock market in the world. When you add up the value of Apple, Google, Microsoft, Coca-Cola, McDonald's, Boeing, all of these great American companies, they add up to about 61% of the value of all companies around the world. And there are about 3,400 companies that you can buy and sell in the US. Now, around the world, there are roughly about 9 to maybe 10,000 other companies in which you can buy ownership. And based on their value, the second largest stock market is Japan. There are about 2,500 different companies in which you can buy ownership there. And that amounts to about 6%. So the Japanese stock market is about a tenth of the value of the US market. And then after that, you have the United Kingdom at about 4% with all the banks and everything that you can buy in the UK stock market. You have France. And interestingly enough, China, which is such a big economic power relative to a lot of other countries. It's the second in the world after the US. From a stock market perspective, it's fascinating, Jason, because the US is 60%. The entire value of all the Chinese companies in which you can buy ownership is about 3%. The US stock market's 20 times bigger than the Chinese stock market. Obviously, a lot of state ownership in China and so forth. But the bottom line is that as an investor, you really need to pay attention to this. So the question is, do I want to just put money only in the US, the 60% or so, or do I want to also buy it from abroad? And I'm going to start with just one intuitive example, Jason, because if you're saying all I want to do is buy US companies and you take a sector that we're all very familiar with, cars, what you're basically saying is that I want to own Ford, GM, Tesla, which are great American companies. And yes, absolutely, let's own that. Now, if you look on the streets in your neighborhood, you might likely see also some German cars like a BMW, Mercedes, Porsche, VW. And those brands are owned by German companies that trade in Germany. Even great American brands, Jeep and Chrysler, they're owned by an Italian company, Stellantis, that trades in Milan. That's Italian investing. So you have to buy that in Italy. We're all familiar with the Chinese and not the Chinese, the Japanese companies, the Toyotas, the Hondas, the Nissans, even great British brands. And it's so interesting because it's ironic that all these British brands like Land Rover and Jaguar, they're owned by an Indian company. And then look at Volvo. It's a Swedish company that is owned by a Chinese shop. BYD is a car company that is selling more electric cars than Tesla. And even if Korean shops are starting to make the inroads in the US. With the idea being this, Jason, that intuitively, if we want to buy car companies, yes, let's absolutely consider Ford and GM, but why not also look at Toyota, BMW, and Jeep for that matter? So I think there's an intuitive way to look at it is that there are companies that we know, companies that we use that are all over the world, and it might as well participate in that. Now, the thing to note is that when we're saying invest in these other countries, it's not a 0-1 game. It's not either put all the money abroad or in the US. But what typically sophisticated advisors do, they start with these percentages. They start with the US being at about 60% of the value of all stocks in the world. And then they say the lion's share, the bulk of the money ought to go in the US. And then you look and say, what's the next largest stock market? And in this case is Japan. So the Japanese stocks as a whole should be about a tenth of the value of the US market. So we're not saying pile up all the money in a particular country or so. No, I would say you got to buy around the world, because companies are based around the world that we know and use. It's not just what we sell to foreigners, but what is also what's being sold to us. But secondly, have a proportion to these purchases and not overbuy certain countries, but rather keep it in perspective. And maybe I'll tell you one quick story, Jason. I was privileged enough to visit with Japanese families in Tokyo last December and meet with them. And a story that came out, I thought it was really interesting for us today. Because a lot of the investors in the US, to your point, they're saying, look, we're in the largest stock market in the world. We have had tremendous performance over the past decade, which we have. And we have these large technology companies that are unstoppable. Why would I want to participate anywhere else in the world when we have these dynamics? And plus, the US economy is crushing it, is doing incredibly well. Right. Back in Tokyo last year, these families were very reluctant to invest at all in the stock market. And I wasn't exactly sure why. So once I started digging a little bit deeper, I realized there was a story that's really relevant to us today. And the story is that a lot of these families started putting money in the stock market in the 1980s. And in the 1980s, Jason, if you remember, the Japanese economy was the envy of the world. I remember my dad giving me a book saying, listen, son, go study Japanese because that's the language of the future. And their economy was just incredible. They had these technology stocks. They were just unstoppable. If you wanted anything of quality electronics wise, Jason might be too young, but back in those days, all I wanted was a Sony Walkman, a Sony Color TV, or a VCR. All of these quality electronic products were coming from Japan. And their stock market in the 1980s had an amazing run. 1 yen invested at the beginning of the decade would have increased sevenfold increase over a decade, more so than the tech boom in the US in the 90s. And here's what's interesting. Because of this incredible run in the Japanese stock market, which today is at 6%, back then it was worth 41% of the value of all stocks around the world. The Japanese stock market was 41%. And here's the fascinating part. The US stock market was 30%. 30%. The Japanese stock market in 1990 was significantly bigger than the US. And those families back in 1990, they were looking and saying, look, we have an economy that is the envy of the world. We have had amazing performance over the past decade. We have unstoppable tech stocks, and we are the largest stock market in the world. Jason, where are we hearing this today? Right. And I'm not suggesting by any means that's the path of the US market. It took those folks 30 plus years to recover their losses because after the 1990s, it completely went south. I'm not suggesting that's the path of the market. I'm just suggesting that things change. And why not be part of that change in a global perspective? Why follow sort of their mindset that they had in the early 90s saying, why would I want to put money anywhere else? Things change, and it's good to be part of that change. And hopefully the US will continue to be the dominant force. I just want to buy myself that assurance that in case things change, I am part of that change. And that's the problem with those folks. And it took them a very long time to recover, where they would have been so much better off should they have stayed globally diversified.
And Apollo, I think too often a lot of consumers will call clients out there that deal with financial advisors, that trust in financial advisors to build a plan and handle their affairs for them and educate and guide them in this holistic wealth management journey, as we call it. They also, in some cases, they have a misconception that the financial advisors, the reason they're good financial advisors is they know how to time the market, right? They know when to get in and when to get out. And I know I find myself having to educate people. That's not the case. And timing the market is not what you even want to do. And that can be confusing for people that just assume that's what we do. But I'd love you to talk a little bit about that, Apollo, and also how it relates to Dimensional's view on timing the market.
It's so interesting because all of us at Dimensional, we all have advisors who help us with our own family. And it's not just about the investment. It's about knowing what type of accounts do you have and which investment should go into which account, something called asset location. It involves taxes. How do you generate income? What's the best time to take Social Security? There's estate planning issues. There's so many facets to investing. And this is just one of them, investing and in what investments to put money. But within that idea of, okay, so there's this big universe of activities and value that advisors provide. One of them is around the market. And as you said earlier, we talked about earlier, people don't like risk. We're trying to mitigate the risk in our daily life. We dress up warmly so we don't catch a cold. We put seatbelts on. So when it comes to stock market, a lot of times people say, I don't want to lose money in the market. And that's a very legitimate concern. You don't want to lose money in the market. Nobody wants to lose money in the market. And there are two different approaches to mitigating this potential downturns in the market. One of them is what we talked about, which is you want to have these buckets and you want to say, I acknowledge that the markets are going to go down. And I know that's going to be the case. Pretty much like where I live here in Los Angeles, I know at some point there will be an earthquake. And the knowledge of the earthquake itself is useless because I don't know when it's going to happen. So I don't live my life trying to predict the earthquake, but I get prepared. And I think in the world of an advice, it's making sure that you have these different buckets. So that's one way to do it. And I think that's a very legitimate, very data supported way to do it. And that's what we encourage people to do, is not to get caught up in anything else, but have a plan and make sure you have these buckets. But there is the alternative, which is a very seductive narrative that, listen, I could potentially get out of the market before it drops. So if I see there's something bad on the horizon, or if I don't think the market's doing very well, maybe there's a time to sell and then avoid the drop and then come back in the market. And that is what's called market timing. The idea of being in the market at the right time, being out of the market when it's not doing well, and being able to make these correct decisions. And I've tried it myself. In fact, over the years, when I was in the PhD program and I had data and computers and all that, I really try to build some very sophisticated models. And there are 2 or 3 things that I learned that I want to share with you. The first one is that it is very intuitively appealing. I just found that when you decide you want to get out, there's an equally important decision that you have to make at exactly the same time, which is, when do you get back in the market? And that's been the hard thing, because I've met so many investors who got scared in 2020 and they said, look, we lost a third of the value in a few weeks. The world's on fire. It's not on fire, but it's basically like we're all standing at home and this is not looking good. And they sold. And the trouble was that they didn't know when to get back. So by the time the market recovered and even went up about 18% that year, they were still missing out because they didn't know when to get back in the market. So folks, it's not just about getting out, but knowing when to get back in. But I think the more fundamental premise of investing that I've learned over the years, which disqualifies this idea of what's called market timing, is that life in general is not about certainty or guarantees. I've been trying to eat healthy. I don't know about you, Jason. You look in great shape, but I've been trying to work out and eat healthier. And there is no guarantee of a longer lasting life. Plenty of buses around. On the other hand, why do we do it? Why do we try to do these things? Because we try to improve our odds. And I think it's exactly the same in investing. What you want to understand is your odds. You want to understand your odds and put the odds in your favor. So what are these odds? And what I mean by this, not too long ago, I had a meeting with a group of retirees who had a club, had an investment club, and they wanted somebody to come and tell them when to get in and when to get out. And I thought I would give them some statistics that have been useful to me over the years and make it relevant to them. Because Jason, what they did all day was pretty much watch the market and then go play tennis. So I thought I would to these folks and relate to them some statistics that I think might be interesting for them and maybe help them with this idea of is it worth doing that market timing, getting in and out of the market. So here are the statistics. If you look at the US stock market, the S&P 500, over the past 50 years on average, and even this year is pretty much spot on the same, you find that quite interestingly, about 53% of all trading days in the market are positive. In other words, you make money in any given trading day in the S&P 500, which also means that 47% of the time, you're not going to make money. And it's quite interesting because it is almost a flip of a coin. It's not obvious that if you look at the stock market any given day, you're going to make money. It's almost be ready to be disappointed half the days. And that's why half those days, though, they had a spring in their step, and the other half, they were depressed, because the nature of the market is to be incredibly choppy on a day-to-day basis. You ought to expect that. That's just the statistics. You have a little bit better odds of making money, but they're not overwhelming. Again, 53% of the trading days in the US stock market are positive, 47% are negative. Now, if you give the market some time, and now you wait for the quarterly statements, over the past 50 years, which is that the S&P 500 had 71% of the quarters being positive and only 29% being negative. And this is where it gets interesting, because if you say, I'm going to be out of the market, it is quite possible that you miss a negative quarter, you pat yourself on the back and you say, great, I saved money.
Right.
But in reality, what is it more likely for you to miss if you were to implement the market timing? You're a lot more likely to miss a positive quarter. And you don't want to play a game where you stand to lose 71% of the time. It's just not the smart thing to do.
Right.
But that's exactly what happens if you try to time the market. You're a lot more likely to miss a positive quarter than a negative one. And if you really are patient enough for the whole year and wait for the annual statements, over the past 50 years, about 78% of the years have been positive and only 22% have been negative. So the more time you give the market to work for you, the better the chances that you're going to see a positive outcome. It's not going to be every day or every quarter, every year, but the more time you give the market, the better the odds that you'll see a positive outcome. And Jason, I was trying to relate to the other hobby that they had, which is market. Not that market should be a hobby, but the other one, which is tennis. And one of the all-time best male tennis players, Roger Federer, who retired 2 years ago, is somebody that I'm familiar with. And I really respect the gentleman. He's a true gentleman, and he had an amazing tennis career. And I wanted to look at his statistics and see, how do you become the world's best male tennis player, arguably? And when you look at his statistics, they're quite interesting and they're quite relatable to the stock market. Roger Federer, arguably the all-time best male player, played over 1,000 plus matches. He retired a couple of years ago. And if you look at his statistics, Roger won 54% of the points that he played, which is nuts, because the all-time best male player lost roughly half the points that he played, which to me was amazing, because he's not an average player. He's the all-time best. Right. The all-time best player, if you were to watch him play a point, it wasn't clear at all that he would be the winner. It was a bit of a flip of a coin. But if you gave Roger some time and you ask, okay, what percentage of the sets did he win in his career? He won about 75% of the sets that he played. And if you're really patient enough to wait for the whole game, he won about 81% of the matches. And I think this is so remarkably interesting, because in the stock market, remember, on a daily basis, 53% of the days are positive. And in Roger's case, 54%. So he's pretty much the same on a daily basis, or Roger's percentage of points won. And the more you give Roger Federer time and the stock market, the more likely you are to see a positive outcome for the market and Roger. So the idea is that if you want to be a successful investor, if you want to be a tennis champion, it is not about getting in and out. It's not about that. It's about being there, playing all the points, winning the big ones. And if you give Roger time, if you give the markets time, you're a lot better off than market timing, because again, then you start putting your odds in your favor if you stay invested at all times. But specifically for that bucket where you ought to have money in the stock market.
Paulo, that was so good. It's the saying that I've been saying for years, and I certainly didn't make it up, but it's about time in the market, not timing the market.
Yep.
And you illustrated that so well for us. And I want to thank you for being here today, Paulo.
It was great fun talking to you. Thank you so much for the invitation. And again, I think the world of what you do and how you help families, it's a true honor for me to be a part of this podcast.
And thank you all for listening, and we'll see you on the next podcast.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. J.L. Smith Holistic Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through J.L. Smith Holistic Wealth Management are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including, but not limited to, age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the investment advisor public disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.